Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's a pleasure to have so many of you with us again in what is our semi-annual busy season. Friends on the web, friends on television, please tune in as well, and of course the full program will be available on our website afterwards. It is a point of pride and pleasure to me that the Institute continues to host its semi-annual Global Economic Prospects meeting, and that David Stockton continues to lead this effort for all of us. This has become, it always was and remains, must-see TV, as it were, for the macroeconomic crowd. And I think you'll find, as always, it is incredible what Dave and our colleagues have managed to do in terms of their depth of expertise and the pointedness of their differences with some of the consensus and some of the official forecasts, even though, of course, we do not have, as Dave used to at the Federal Reserve, a stable of a few hundred PhDs and computers and all the rest. And even though, of course, we now have Dave and our colleagues go out there before the WEO and before some of the other official sector stuff makes their call. As always, our point is to inform, to nudge the consensus and nudge the market people, but most of all to nudge the policymakers where we think the risks are, where we think things are underappreciated or overthought. And we have a very exciting program to do that today with the three major regions of the world. First off, as mentioned, is of course David J. Stockton, who has been a senior fellow here at the Peterson Institute after retiring from the Board of Governors of the Federal Reserve, where he was Director of the Division of Research and Statistics, and of course, therefore, in charge of briefing the FOMC on the forecast, running the forecast, and as chief economist. He also maintains a role as a senior advisor at Macroeconomic Advisors, LLC, and but is a very active member here, and we're delighted to have him leading this effort. He will be talking about the global overall picture for growth over the next couple years, but of course, as always, focus heavily on the U.S. and the macroeconomic prospects and policy challenges here. Dave will be followed by what we try to do at least once a year, which is have Nicholas Lardy speak. There's an old saying, when E.F. Hutton speaks, people listen. When Nicholas Lardy speaks, people who care about China listen. Nick is, of course, the Anthony M. Solomon Senior Fellow here at the Peterson Institute. He's been with us since March 2003. He's the author of the recent, I think, superb and groundbreaking book, and you don't have to believe me, you can read the global reviews from Markets Over Mao, which we published a few months ago, and which is currently being translated into Chinese, and I think the Chinese Politburo on all reports had advanced translation copies. He's just back from representing the Institute along with Jeff Schott and Sean Miner at the China Development Forum, and is going to give us his latest insights into the prospects for the Chinese economy. And again, it's not just forecast, although that's the emphasis today. Nick, along with many of our colleagues, is part of an Asian Development Bank funded study that we've been doing on financial reform in Asia, and there's several working papers came out over the last week under the helm of Marcus Nolan, and Nick Lardy, along with his protege Nick Borst, have a terrific paper on financial liberalization in China, which I'm sure will inform today's remarks. Concluding our opening presentations before we go to discussion with this esteemed audience is my friend and colleague Jacob Kierkegaard, who's been affiliated with the Institute since 2002 and has been a star here since shortly thereafter. We're working Jacob very hard this week. Yesterday, he appeared in our substantive discussion of wage growth in the U.S. and corporate behavior, where his expertise on comparative welfare states, labor markets, pensions came to the fore, and that remains a core part of Jacob's research. But in addition, Jacob remains, as most of you know, the leading astute commentator on the political economy of the Euro area, a star of stage and screen, and one who's gotten an unbelievable number of calls right. I started calling him Mrs. Merkel. I could also call him Mrs. Draghi. Either way works. But Jacob will be taking us through his well-reasoned, and we will see how persuasive take on why, even as people upgrade their views on the outlook for Europe, they're probably not upgrading them enough. He, of course, also is available to answer questions about minor things like Greece. So with that to go, we will have our three presentations sequentially, and then my colleagues and I will be up on the panel and be able to take questions and comments from the audience. Thank you all very much. David, over to you.
Thank you, Adam, and thank you all for joining us this afternoon. I guess it says something about the state of the U.S. entertainment industry when Stockton, Lardy, and Kierkegaard become must-see TV, but we will try to live up to that exciting description. So basically, I think we're looking at another year, 2015, of disappointing economic performance for the global economy, but one marked by very considerable divergences in economic performance and economic policies. As you can see, I'm expecting growth on global output on a PPP-weighted basis to be 3.3% in 2015, not much different than 2014 before picking up some. But again, I think the theme we want to strike is just how different performances are across the globe. So in the euro area, I think we have a more optimistic than consensus outlook at this point, with a pickup in growth to 1.75% in 2015 before moving up further to about 2% in 2016. I think Jacob will give us the reasons for that increased optimism for the euro area. In Japan, I think it's clearly a continuing weak economic performance. We're expecting an upturn in activity, but less than 1% in 2015 before improving further in 2016. Despite the current weakness, I think Japan is going to benefit significantly from lower oil prices and from the depreciation of the yen, and I think that underlies and underscores the acceleration we're expecting. In the United Kingdom, much like the United States, things look like continued solid economic performance. I would expect over time to see a little bit of a deceleration, given that some of the strength in the UK economy has been generated by consumers spending more rapidly than their income growth and drawing down saving, and some slowdown in housing as well. In China, I am forecasting a very gradual slowdown to a little bit below 7% over the course of the next 2 years. Largely on the basis of weaker property markets and construction, and Nick will explain in much greater detail his views about the Chinese economy. The real star in the global economy at this point, to us, looks to be India. And we like to call this the Subramanian effect, after our colleague Arvind Subramanian, who's now chief economic advisor to the Modi government. But I think that moniker is intended to embrace a broader set of better macroeconomic policies and better structural policies that I think are leading to a more favorable outlook for the Indian economy. There are a couple of economies that aren't on this slide that I guess I should mention quickly, where we are considerably below consensus. One is Russia, where I think my colleague Anders Åslund has really been way ahead of the curve in recognizing just how deep a contraction is likely to occur in Russia, where we're expecting output to fall at about an 8% rate in 2015, and for the contraction to continue to linger on into 2016 as well. The second area where we're below consensus is Brazil, where we're expecting a decline in real GDP of about 1.5% in 2015, before not even fully retracing that decline in 2016. Now, there's a third economy where we're below consensus as well, and that's the United States, where I'm forecasting now growth in real GDP for the U.S. economy about 2.75% this year before slipping to a little bit below 2.5% in 2016 and 2017. That's well below the 3% blue chip consensus forecast currently, and certainly well below the IMF's January WEO update that had the U.S. economy at about 3.5% for 2015 and 3.25% in 2016. And I'll explain why it is I'm more pessimistic than the consensus on the U.S. economy. But actually, I think what you should focus on about this is not so much just the difference between my forecast and the consensus forecast. The U.S. economy, the bigger story here, is doing just fine. We're continuing to grow above trend. We're continuing to take up slack in labor and product markets. We're growing fast enough probably to put some upward pressure on inflation over the course of the next couple of years. So I wouldn't want you to lose sight of the bigger message, which is, in fact, despite the fact that there's been some significant swings in sentiment about the U.S. economy, with I think people becoming far too optimistic late last year when things were really booming along, and I think much more too pessimistic now about the recent slowing, things are going to be just fine here. As you think about the general tenor of the U.S. economy and some of the reasons why the general tenor of the U.S. economy has improved over the course of the last year or so, is one important element is the end of these significant self-inflicted wounds that were associated with the very substantial cutbacks that were occurring, especially on the federal side, but also on the state and local side. Last year, the federal government finally went back to just about a neutral stance on fiscal policy, and it's just going to be a small plus, perhaps, over the course of the next 2 years. Really, the unsung contributor to the change in overall fiscal policy for the U.S. economy in the recent years has actually been a substantial improvement in the state and local sector, where, in fact, improving property values and improving retail sales were helping boost tax revenues and providing those governments the opportunity to restore some of the spending that had been cut so deeply during the Great Recession and restoring some of the employment that had been lost as well. So I think that's certainly been a helpful factor. We still have, obviously, some significant near-term challenges, speed bumps for fiscal policy, not that far ahead. We are now operating under the debt ceiling once again. That clock is starting to tick, and it will be likely that by late summer, early fall, an increase in the debt ceiling will need to be voted upon. That certainly presents some risks. And of course, we'll need a budget by the end of September in order to prevent spending to move back to sequester levels. So I think there are certainly, this forecast that I'm presenting assumes we just go over those speed bumps and move straight ahead. But clearly there are some risks associated there. As has been the case with my forecast over the last year or so, the most important element in generating continued above-trend growth will be what happens to consumer spending. Now, on the fundamental side, clearly the improvement in the labor market that we've experienced over the past year is going to be an important element in helping to sustain incomes and growth in spending. In addition, household balance sheets have continued to improve. There have been substantial increases in net worth relative to income. That's being driven, of course, primarily by improving property values and increasing equity values. And on the liability side as well, there still continues to be a situation where consumer debt burdens are exceedingly low in the United States currently. And so I think they're going to have some wherewithal. Now, I don't usually show the non-fundamentals, but in this case, there's really been a dramatic shift in consumer sentiment over the course of the past year in a favorable direction to where the point is that we're now considerably above where we were not all that long ago, and certainly back to pre-crisis levels of consumer confidence. And quite often, some significant shifts in consumer confidence do provide some incremental predictive power for the outlook for consumption. And if it was just this, I guess I wouldn't be as impressed. But I always think of one real-time indicator of consumer sentiment to be their purchases of motor vehicles, which at the 17 million unit annual pace is quite strong. So I think we're seeing signs, in fact, that the household sector is poised to continue to spend more rapidly than they have in the more recent past. And of course, another factor behind that has been the very substantial decline in the price of energy and oil. This is translated into more than $1 decline in the price of a gallon of gasoline, increasing consumer purchasing power. And I think that's certainly been going to be an important factor helping to support spending, and it certainly has, I think, probably been a factor in the improvement in consumer confidence. Interestingly, we've seen this before. If you look at the mid-1980s, there was a similar size in percentage terms drop in oil prices. And much as the current futures prices are predicting a moderate rebound from this very, very deep low level, we saw something like that as well in the second half of the 1980s. And for much the same reason, I think we saw a strategic decision on the part of the Saudis to shift from defending a price to defending their market share. And I think in the mid-1980s, of course, that was North Sea oil. In this case, it was more the unconventional oil and energy being produced in the United States that was driving that. That obviously, we have a slightly different situation than we did previously. In the past, I think when we thought about changes in oil prices, we really focused on the consumer side and the boost to consumer purchasing power associated with lower oil prices. And that's happening again. Those are, as you can see, a very substantial contribution to the change in disposable income from the drop in energy prices. But we do have a new complication in terms of assessing the overall net effect of lower oil prices, and that is that there's going to be a significant drop in both extraction and mining and extraction associated with the drop in oil prices. And you can see there's already been a significant retrenchment in the count of oil and gas rigs in use, and that is going to be an offset, not a complete offset, not even a substantial offset, but an important offset to some of the strength that we'll get from consumer spending from the lower oil prices. Lower oil prices, of course, have had effects and will have effects on spending and real activity, but in addition, they've had some pretty dramatic effects on inflation. So if you think about what's happening now, if you look at inflation in the major advanced economies, it's basically gone. We're basically looking at something that looks like price stability. And of course, central banks have appropriately said, that this is going to be a transitory factor, and indeed, I think it will. But it's still the case that if you look at core inflation as well has dropped in all the major advanced economies. Obviously, some of that could be a pass-through from lower oil prices into things like airfares and other kinds of transportation. But it also, I think, is reflecting the fact, and you can see central banks have been missing their 2% target now, really for a very long period of time. But one of the important elements of this particular chart is we're a lot closer in the United States to our 2% target than either Europe is or Japan is. We're in a very different position. However, we're much closer, and this is an important element in thinking about important ways in which there is a divergence in global economic performance. The second important way is taking a look at what's happened to unemployment and the amount of slack there is in our various economies. Slack has been eroding much more rapidly in the United States than it has in Europe. Japan was already pretty low on the on the unemployment side, but you can see a very substantial divergence here in terms of the cyclical position of the U.S. relative to Europe. And the point I guess I'd want to stress in this is this divergence, both on the inflation side and on the unemployment side, isn't going to be reversed if Europe ends up being a little stronger than people are currently expecting, or the United States a little weaker. This is going to be a divergence in performance that's going to be with us for some time. And I think we see that in some sense reflected in long-term interest rates, which have declined quite dramatically in the euro area, especially in Germany and in Japan as well. They've come down some in the United States, but taking a look at this, you can see interest differentials have widened very dramatically over the course of the last 2 years. Obviously, the timing of that widening in interest differentials differs between Japan and Europe. Obviously, the Governor Kuroda's commitment to expanding quantitative and qualitative easing really began to come to the fore in early 2013, and we saw, in fact, a significant widening of spreads occurring over the course of that period. In Europe, it's been a more grinding increase in the interest differential. I think if you think back to sort of the policy dialogue policy and analyst dialogue over the last year or so. I mean, there's been a huge amount of discussion about the ECB. It was should they, would they, could they? And finally, of course, I think as economic activity continued to disappoint, and I think even more importantly, as inflation began to move down and inflation expectations, the ECB finally had and Draghi finally had what he needed to move much more aggressively, and more aggressively than people thought he would. And so these interest differentials have shown through, of course, into a very substantial swing in exchange rates at this point. And that's occurred not just with respect to these major currencies, but also to the broader measures of trade-weighted currency exchange rates. So we're looking at a very substantial shift in the exchange rate outlook. My forecast is predicated on basically sideways movement from here on these major currencies. And I see that, in some sense, that forecast reflects the fact that you can't do much better than a random walk on an exchange rate forecast. And pretending that you can do so usually leads to more forecast error than not. But if I look at the risks surrounding this, yes, there's a risk that perhaps things have already overshot some and we could see some movement back down in the dollar over the course of the next year. But I think the greater risk is that this divergence continues some, especially as talk of Fed tightening really begins to turn into from talk into actual action. I think there's more upside risk than downside risk associated with this. So if you think about the changes that have occurred, there's a lot to net out here for the U.S. economy. Oil prices down substantially, probably a plus for the U.S. economy. Exchange rate appreciating significantly, a little weaker foreign activity, probably a negative. So this slide reports some simulation results produced at Macroeconomic Advisors using their large-scale macroeconometric model. It takes a look at the change in conditioning factors from June of last year until the current period and tries to assess how those various factors net out. And as you can see here, the lower oil prices are providing right now are expected to provide over the course of this year a bigger boost to activity than the dollar and weaker activity are producing a drag. But that ends by the end of this year. If you think about the earlier slide, and again, my oil price forecast is basically based on futures prices, there's an expectation that oil prices are likely to bottom out in the near term and then actually start to move up. So this boost we're getting to activity from lower oil prices begins to fade some, but the drag on activity from the appreciation of the dollar continues to mount over the course of the next 2 years. So one can quibble about the exact size of these effects and whatever, but the important point here is, in fact, and I think it's an important point for policymakers, is the Fed certainly told us that it's important for them to look through the effect of lower oil prices on the inflation outlook. But I think it's going to be important for them if, in fact, activity picks up as I expect, and they appear to expect as well, over the course of the remainder of the year, for them to look through the temporary boost to activity being provided by the lower oil prices and take on board the longer-term drag that is likely to occur from the appreciation of the dollar. So I think there's an important policy outlook issue there. In terms of Fed outlook, here I plotted the median FOMC participants' forecast for the federal funds rate made last June. And in fact, where they are this March, they've moved down considerably. Now that's probably a reflection of several factors. One is they've got a lower natural rate of unemployment, probably a lower equilibrium interest rate, but I think they've also taken on board the strengthening of the dollar that's occurred. Having said that, I don't think they've moved far enough yet, and I think, in fact, ultimately, this drift in the federal funds rate and in monetary policy is going to be even shallower than they're currently expecting at this point. And the reason for that, I think that it will be, is for two reasons. One is I do think they're going to get more restraint from their tightening actions on the dollar and on that in terms of on overall economic activity than they're currently anticipating. And I do think the other area is the housing market, which remains quite fragile despite the fact that mortgage rates have been so incredibly low. We've seen a housing recovery. It's continuing. I think that looks good. But I think as mortgage interest rates move up pretty much in tandem with the 10-year Treasury, it's going to be the case that they get more restraint on activity than they're currently anticipating. And I think they'll have to end up going more slowly than they're currently forecasting. Quickly on the labor market, because this has been such a central focus of our presentations in recent years, but won't be today, the labor market has repaired significantly. I think many people were really wringing their hands about last Friday's employment report, but in fact, employment gains over the first 3 months of this year averaged about 200,000. That's a little better than they were over the first 3 months of last year. It's true that that's a lot slower than they were over the most of the second half of last year, but we had GDP growth that was averaging about 4% over the final 3 quarters of 2015. That's certainly, unless you thought that was going to continue, we were unlikely to continue to see employment gains of that magnitude, and I'm expecting employment gains of a little bit north of 200,000 per month over the course of the next few months. I guess I'm not sure you can see this here, but in terms of the unemployment rate, you know, my point estimate for the natural rate of unemployment is 5% for the U.S. economy. At 5.5%, we're still above that estimate, but more importantly, I think, than a point estimate, which is almost ridiculous for something like the natural rate of unemployment, an honest assessment of what a 70% confidence interval for the natural rate would be for the U.S. economy is roughly plus or minus a percentage point. So it's somewhere in the 4 to 6% range, and that's about as good as we can say. It's the case that the broader measure of unemployment has also come down significantly. It's still a little bit above its normal historical relationship to the unemployment rate, the official unemployment rate, but not decidedly so anymore. We've really seen a significantly pretty broad-based improvement. And so I do think certainly, you know, the time to start thinking about tightening policy is pretty close at hand. But I would say this, I think the Fed can just leave the punch bowl for a while here, because the guests are still arriving at this party. So, what I'd point to for that is we really still, despite the improvement that we've had in the labor market, despite the decline in the unemployment rate, we haven't seen much in the way of upward pressure on wages yet. Certainly the ECI has tipped up a bit. If you take a look at the average hourly earnings measure, it too is still pretty much running close to sideways, and as is the broader national income accounts type measure. Now, having said that, I do think looking both at the higher frequency measures of what's been going on with wages and the anecdotes, that we probably are beginning to see the early signs of an acceleration in wages. And for the ECI, in fact, I am forecasting a pickup over the course of the next 2 years. I do think we're going to begin to see some upward pressure there. And in terms of its implications for inflation, not much implication from rising wages, because I'm only expecting wages to be rising at the end of 2017 at about a 3% annual rate. Certainly, headline inflation's been low, core inflation's been low. If you like trim to means, it's sort of throw out the outliers, that's remained low. I think we're looking again at another 2 years of inflation continuing to run short of the Fed's inflation target here. So in conclusion, I got a couple of main points that I guess I think need to be made. One is the global economy is going to benefit from the aggressive actions being taken by the ECB and the Bank of Japan at this point. We need stronger Europe. We need a stronger Japan. We need a stronger global economy that would be associated with that. The likely divergence in monetary policies, however, between the United States and Europe and Japan are going to create some challenges that are going to have to be addressed. And indeed, part of the way that QE works in Japan and Europe, as well as it did in the United States, is by boosting domestic demand through lower cost of capital and higher asset prices. But part of it works through the exchange rate, whereby the depreciation of their exchange rates and the appreciation of the dollar is taking global demand away from the United States and moving it towards Europe. So we can benefit from this. We can make this a win-win situation as long as we recognize that demand shift that it's occurring and that the Fed follows an appropriately accommodative stance as well to maintain domestic demand in the United States. And finally, a point that I've made before, as I look at the world economy, we need central banks to remain committed to their 2% inflation objectives and not explain it away or acquiesce to it. We've been through now already 6 years, and by my forecast, we'll have another 2 more, a persistent undershoot. I think that creates serious vulnerability should we get hit with another shock with interest rates and inflation being as low as they already are. I think we could be in a more difficult situation. So I'll stop there and turn over to, yeah.
Well, thank you very much. I'm sorry, it wasn't showing on my screen, so I didn't think it was up. When I last spoke on China at the Prospects meeting, it was the fall of 2013, and my title was China's Indigenous Slowdown, and it's still China's indigenous slowdown. The growth continues to slow, and it's largely for domestic reasons. You can see the slowdown. The recent peak was 2010 at roughly 10.4 growth of GDP. We're sliding down from that, going down to 7.4 last year. And this coincides with a big slowdown in the growth of investment in property. You can see we're now sliding, we were at 30-some% not too many years ago. We're down to 10% last year. So property investment has slowed dramatically. In the first 2 months of this year, it's growing at roughly half the pace that it grew at last year. That has dragged down the production of a lot of key construction materials, particularly steel and cement. Also affects coal, since producing steel is very energy intensive. And that has, of course, led to a significant slowdown in industrial output and investment in the industrial sector. So I think the slowdown, particularly since 2010, is largely due to the continuing softening of the property market. Now, my view, of course, is that this is actually a good thing. China has been overinvesting in property for quite some time, and if they use this opportunity of the slowdown in property investment to push through on all the economic reforms that have been discussed, I think there is the potential to move to a more stable and more efficient path of economic growth going forward, one that is more reliant on private consumption demand rather than investment. And I just want to give you some of the early indications that there may actually be moving in that direction. First, disposable income. Most of the decade of the 2000s, as you can see, was a big decline in disposable income as a share of GDP. That has now been ticking up a bit since around 2009. That's a result of substantial continued growth in wages. And also, despite the slowdown in economic growth, we've seen a substantial increase in employment generation in 2013 and 2014, not shown here. This is from the flow of funds that comes out with a big time lag. But I think by the time we get the data for 2014, we're going to see disposable income up in the neighborhood of 64% of GDP. The other positive trend is that the household savings rate, which also, of course, it's in the stratosphere by any other country that we've ever looked at, but it continued to rise for most of the decade, but now has been leveling off and actually coming down a little bit the last couple of years for which we have the data. So the combination of rising disposable income as a share of GDP and a slight softening or slowdown in the savings rate has meant that private consumption expenditure as a share of GDP is going up. Again, if you look at the early years of most of the decade of the 2000s, GDP growth was much more rapid than private consumption expenditure. But in 11, 12, and 13, we have private consumption expenditure growing more rapidly than GDP, so the consumption share is going up. I think that trend continued last year, but the official data on GDP by expenditure are not yet out. So we are seeing some rebalancing, and the growth of private consumption expenditure is making this moderation of investment in property offsetting some of the moderation in investment in the property sector. Now, the risks, David has already mentioned one, and that is, well, what happens if we have a further slowdown in property investment? After all, remember, it still grew at 10% last year, so it's growing more rapidly than GDP. And of course, the underlying reality here is that prices have begun to soften. We're now in the sharpest price decline. Of course, this is nothing by U.S. standards or other places that had big housing corrections. But for China, where prices have been pretty much in an upward trajectory for a long period of time, this is a substantial adjustment, and I think is having an effect on expectations about the desirability of investment in property. This is extremely important. China probably has the highest home ownership rate of any large economy in the world. It's significantly above 90%. A very significant portion of the demand for property in recent years has been property as an investment. There are tens of millions of housing units that have been sold to people that already have a place to live, and they're sitting vacant because they thought they'd be a very good investment. So when you get this change in price trends persisting for a longer period of time, the desirability of property as an investment is probably going to decline. Sales have been falling now for some time. This is lagged 12 months or rolling 12 months. But last year, sales were down 8%. In January, February, on an over-a-year-ago basis, they're down a further 16% this year. New starts have fallen. I'm going to save that one. New starts have also fallen quite dramatically. They declined 11% last year overall. Residential new starts were off 14%. In January, February this year, residential starts are down 20%. Now, eventually, if starts keep declining, there's a risk that the absolute amount of investment in property will shrink. The investment rate has, in other words, been held up in part by the completion of projects that were started a couple of years ago. Once the new starts start tapering off quite significantly, there is a risk that property investment could turn negative this year or next year. In other words, not just a continued moderation in housing investment, which we've seen over the last 5 years, but an absolute shrinkage of investment in housing, which could obviously reduce economic growth significantly going forward. So that's risk number one, a sharper correction in housing. The second problem is in the financial sector. This has gotten a lot of attention. I spoke about it at our deleveraging meeting, so I won't go into all the details here. The reality is that there's been a massive increase in credit relative to GDP since 2007, and it has really been across the board. It's an increase in government debt, it's an increase in the corporate sector debt, it's an increase in the financial sector debt, and it's a significant increase in household debt relative to GDP. So we're now up in the neighborhood of, I suspect by the end of last year, something roughly speaking about 300% of GDP, which puts China in the company of advanced industrial economies and certainly far ahead of most emerging markets. Now, there are some mitigating factors at work here. First of all, the foreign currency component of the debt is very, very small. There's only a very modest currency mismatch. Household debt, as you can see here, has gone up quite a bit in relative terms, but it's still relatively low compared to disposable income. Almost all the household debt is mortgages, and the leverage ratios on mortgages are very, very low. Big down payments are required or have been required for buying something beyond a single residence. China does not have such things as refinancing and home equity loans and things like that, so the loan-to-value ratio is probably somewhere in the neighborhood of 20 to 30%. So there's not a lot of financial risk associated with the housing market. Third mitigating factor is that almost all of this credit is being financed by bank deposits, and the loan-to-deposit ratio in the banking system is roughly 70%. And that's very low compared to the ratios of 125, 150% that we usually observe in other emerging markets that have banking crises. So China is not in the stratosphere. A fourth factor is that there's virtually no securitization of assets, and that means we have no derivative products that are tied to such assets, no collateralized debt obligations and other things lurking in the financial sector. And finally, the authorities have recognized the risk of excessive credit growth, and as you can see in this diagram, they have been moderating the rate of growth of credit since 2010 and came down substantially in 2014. The absolute amount of new credit extended last year was 5% smaller than in 2013. It's still too rapid. Debt to GDP is still going up. In the first couple of months of this year, credit growth has moderated further. So the authorities are recognizing the risks associated with too rapid credit growth, and to their credit, they were willing to accept a lower rate of growth last year, missing their 7.5% growth target. They resisted the calls that were very widespread for further easing of credit conditions. They have also put in a lot of regulations that are shrinking the extension of credit in the less well-regulated parts of the financial system. You can see here that plain vanilla bank deposits shrank quite a bit as shadow banking expanded after 2009. This year, we're seeing two trends. One is that bank loans are again the dominant source of credit. We've had also a significant pickup in equity and bond issuance as a source of finance, which I think is fundamentally positive for the system. And shadow banks are being very heavily regulated now. If you look at the most recent data for February, 85% of all the new credit created came in the form of plain vanilla bank loans. So the scary parts of the financial system are getting squeezed out. So my conclusion is that, as I said at the outset, China's slowdown is almost entirely indigenous. The moderation in China's external surplus has not had a significant impact on its economic growth since 2010. The big hit they took was in 2009 when the shrinkage of the surplus knocked off 3.5 percentage points of GDP growth. That has not happened. We're talking a few tenths of a percentage point of GDP growth in the last 4 years. The second conclusion is that the reform has led to some economic rebalancing. We're getting some pickup in private consumption expenditure, offsetting some of the decline or the moderation in housing investment. The biggest risks are a more rapid property market correction and the central bank succumbing to pressure for more rapid credit growth.
Well, thank you very much. It's a pleasure to be back because who doesn't want to bring relatively good news? And I would also say that I think the last time I did the Euro area outlook for this session, the good news I had was that actually the Euro wasn't going to collapse in a few days. Today I would say that not only isn't it going to collapse, but contrary to what a lot of people perhaps were forecasting not so long ago, it can actually grow again. So it really is, in that sense, also good news on the growth front. So I want to talk a little bit about why I think this is going to happen. I want to talk a little bit about the ECB monetary policy. I can't do a forecast really without talking about Greece, so I will do that. But then also at the end, I want to talk about the risks and actually why this optimism that I bring here is still, as you can see, range-bound or has a certain prudence to it. But I think Adam may have talked about this being must-see TV. But personally, I'm much more excited in joining the forecasting profession right at the peak of its societal importance when it becomes the subject of analysis of the daily Dilbert, which forecasting has been for the past couple of weeks. And I would say that since we know that Dave was the FOMC funny man in 2009, now this is particularly appropriate to be joining the forecasting profession right now. But anyway, back to the Euro area. I basically agree with Dave's forecast, and except that I'm a less experienced forecaster, so I have to rely on it as a range rather than a point estimate. And which means about 1.6 to 1.8 this year, up to perhaps 2% in 2016. And I put in here both the forecast, but also the consumer confidence indicators, which, similar to what Dave said in the US, is actually in Europe way above its long-term average for the first time since pretty much before the crisis. And I think this is not the only one. If you look at other high-frequency indicators, PMIs, sentiment indicators, etc., you will actually see that all the short-term indicators point in a direction that would suggest that the growth rates that we have in this is where we're going to end up, which is not bad, I would argue, for a currency area that is already in structural labor force decline. We will, in the euro area, as a result of this, be growing considerably above potential, in my opinion, in both this year and next year. Partly, of course, because the euro area potential growth rate, which I'll talk a little bit about at the end, is probably not much more above, in the best of cases, 1.5%, which leaves you to the case of the broader question that has this crisis really been wasted in a structural sense? Has the reform progress that we have seen undoubtedly in some countries of the euro area been matched or trumped by this prolonged period of high unemployment and therefore renewed hysteresis fear? I think this question is still open to debate. So we cannot therefore be quite as optimistic as I would like to be. But there's basically four reasons for why I think this is going to happen. First of all, oil prices in the euro area really does matter quite a bit. And there isn't the kind of net offsetting effect. There's no North Dakotas in Europe, with due apologies to Norway on that front. But really, this is an unambiguous positive, and probably the best, the closest equivalent you can get to a fiscal stimulus, a sizable fiscal stimulus in the euro area, which, combined with the fact that the broader fiscal consolidation in the euro area is abating, is unambiguously good news. Now, it feeds into consumption probably less dramatic than in the US because the cost of gasoline is so heavily taxation, but at the same time, combined with the outright headline deflation that you have seen, disposable incomes have gone up in the euro area as a result of this. And you also have a basically zero interest rate environment, which leads me to conclude that probably a larger share of the disposable income increase we've seen in the euro will be consumed rather than saved going forward. So this is really good news. It also has had, I would argue, the effect of delivering unprecedented monetary stimulus from the ECB, in the sense that I would argue that if it hadn't been for the oil price decline, we probably would not have seen the kind of asset purchases that the ECB have now launched. So you have a double whammy positively here, and obviously if you want to do QE, what better way to do it than on the back of a huge positive supply shock rather than a deep crisis? Then the third argument I would say is that Russia isn't going to make the kind of damage or cause the kind of damage that it did last year. I don't think there's any doubt that one of the major unexpected drags on euro area growth last year was the effects of Russia, the Russia-Ukraine crisis, and the sanctions. But that's essentially water under the bridge today. And then finally, there's of course also the exchange rate, which has the positive effect, at least in the short run, and I don't think I would play up the longer-term growth-boosting effects of the exchange rate for an economy as large as the euro area. But in the short run, it matters, and it particularly matters because it means that the growth in the euro area today is much more broad-based than it has been for a long time. So we're not talking about a one-engine, sort of German-led euro area recovery. It's much, much broader-based. But onto the European Central Bank, where I think two things. One, which is probably not a view that is widely shared in this building, but I actually believe that the ECB's actions were timely in nature. Because I think the fact that they came at the point that they did meant that there was a degree of consensus around this in the euro area. That means that today the debate about what QE is over. It's essentially just another quote-unquote normal monetary policy instrument that you can use at certain points in time. But that consensus wouldn't have been present if you had it introduced at an earlier point in time. I would also keep in mind this is a big program. Because if you look at it, at the end of this program, the ECB balance sheet will probably certainly be north of 30, probably even 35% of euro area GDP. The ECB may well own 12 to 13% of all eligible public securities, which is not far off what the level of the Fed 3 QEs have been, because we should keep in mind that QE by the euro area, by the ECB, is going to be conducted at a period of time where the expansion of supply isn't going to be as big as it was in the United States. TLTRO's long-term liquidity provision is probably, and this is what you can see here, is a pro-cyclical monetary stimulus instrument, I would argue. So we shouldn't be surprised if it picks up, and the dotted line you see over there on the far left is basically just assuming a continuation of TLTRO pickup similar to the previous auction in March, which would mean that the ECB balance sheet is going to be $3.5 trillion at the end of this. But I would also say that for all of this very accommodating, very stimulative high effect measures, the ECB is not the Bank of Japan. It is not the Bank of England, and it is not the even the Fed. I would argue that it continues to have a fairly sizable blocking hawkish minority, which means two things. One, that the program as it was announced runs until September 2016. I think the bar for changing that, no matter what happens to the forecast, is very, very high. So the idea that some say we're going to end it prematurely and things like that, I don't think that's going to happen. But I think on the other hand, I think it will be very difficult to expand the program beyond September 2016. Now, a little bit about Greece. We can't obviously talk about this without Greece. I think there's really two things to say, and this is a chart here that basically just puts debt and debt servicing costs on the X and the Y axis, and Greece is obviously the outlier to the far left corner. Just to indicate that an exclusive focus on gross debt levels in Greece is, in my opinion, somewhat misguided. This is a problem, first and foremost, for the Greeks, I would argue, because this crisis that we're now seeing takes place in a period where, because of QE and the broader cyclical upturn, there is no contagion in Greece. But we also have a situation where there is basically no trust between the current Greek government and the euro area, which means that we're in a situation where liquidity and fiscal support will be drip-fed to Greece, so that you will not have a deal until the euro area feels reasonably confident that the Greek government is going to do what they want them to do. This prolonged standoff that we right now are in the middle of is going to be damaging to the Greek economy. I don't think there's any doubt about that. But the reality is that the Greek economy, the Greek government has very little leverage. And the idea that, Alex Tsipras is going to go to Russia and that Russia is a substitute in some ways is an illusion. It's not credible. But at the same time, it's very clear that there is no public majority in Greece for a Grexit option. If it comes down to a choice between yes or no, there is no public majority for it. And I would argue that no government in Greece can take Greece out of the euro area without an explicit public mandate to do it, and they won't get it. And at the same time, I don't think there's any willingness, despite the occasional sort of leaked story about German politicians pushing Greece out of the euro area, because I think it would be a disastrous policy So ultimately, I think the key here is that we're trapped in this sort of long grinding process that we're in right now. But more importantly, also, I would say that Syriza doesn't have much political appeal elsewhere in the euro area. The idea that the Greek elections in January have any predictive effect on elections in Portugal and Spain at the end of this year is nonsense. And I think the polls show that out. And then finally, I would say that the banking union is an important and underappreciated element in this whole saga, because it complicates and in fact constrains the Greek sovereign in its fights vis-a-vis the national banks in Greece. But why then, Dave insisted that I put this slide in for the downside risks to this. I would say, first of all, the downside risks that I have in this are actually quite modest. And I would say, obviously, oil prices could go up again, no doubt about that. We could have an renewed expansion. Putin could make a dash for Kiev or something like that. Or the Russian economy could implode. So there is, other things could go wrong. And Grexit, I could obviously be wrong. Grexit could happen, but I think it's important we recognize that the possibility of that is not 30%, it's not 20%, it's not 10%, it's probably 2%. So it really is a tail risk. But why does growth want to be range bound? Well, Dave already showed you that there's a lot of slack still in the euro area. And it really takes quite some time for that to be digested. And perhaps more importantly, unlike the United States, deleveraging in the euro area has hardly begun, which is what you can see here. Whether you look at the banking sector, the non-financial sector, the household sector, or certainly the government sector, deleveraging in the euro area hasn't begun. So this is a process that's going to take its toll over the coming years, and therefore clearly means to me that where we are on this forecast is about as good as it'll get. And then finally, the structural reform prospects for the euro area that are necessary to raise the potential growth rates is also highly uncertain, because I would argue that complacency is a big risk. And I think I will stop there. Thank you.
Thank you very much. If you boil it all really down, we got a trio of happy-go-lucky optimists here. Now we'll unboil it, unpack it. I will go right to questions from our esteemed audience. This is all on the record. As usual, Jessica is up front with a wandering mic. We have a standing mic at back. Please raise your hand to be recognized, and again, we'll ask our internal fellows to hold their fire for a little bit and let our external guests have first crack. Does anyone want to go first? Yeah, right there.
This question is for David. If I read your numbers correctly, you are forecasting a rise in the participation rate of labor. And if I'm right, why is that so?
Sorry, could you identify yourself, please?
I'm Larry Krause.
Okay.
So actually, I'm forecasting a slight decline in the participation rate, just a little bit. I do think there's still some cyclical shortfall in participation relative to trend. But basically, the reason that I'm getting continued declines in the unemployment rate with such meager GDP growth is an anticipation that we'll get a little further tailing off, but certainly not a significant one. And if there were a further significant fall in the participation rate, obviously we'd be looking at a much tighter labor market than I'm currently forecasting.
Next. Anyone? Okay, Rich, come up to the mic.
Rich Miller with Bloomberg. I wonder if I could ask Dave if you could just, I take your point that your basic forecasts are still pretty upbeat for the U.S., but I wonder if you could just sketch out a little bit more where you are a little more pessimistic than the consensus. And for Jacob, I wonder if you could sort of, you mentioned that growth is in the euro area is more broad-based, and it's not just a German story. Obviously, there's been a lot of criticism recently, including from Ben Bernanke, the new blogger, about Germany and its trade surplus. I wonder if you could, go a little bit more into what you were talking about on the broad base. Thank you very much.
Before my colleagues reply, I have to tell Rich and the world, Ben Bernanke is very much a Johnny-come-lately to that argument. A number of us have been making that argument for years, and you can go back to Jacob's recent publication on Germany's response to a surplus. You could also go back to Fred Bergsten's remarks on Germany having a subsidized exchange rate by virtue of being in the euro area. Ben's brilliant, but he didn't add anything to that we hadn't already published. Dave?
So I'd cite two areas where I think things are likely to be weaker than the consensus forecast over the course of the next 2 years. I do think the appreciation of the dollar will bite more on our on exports in terms of suppressing exports and boosting imports, siphoning off demand from U.S. producers and moving it to foreign producers. And that's going to be a bigger drag on overall activity than is commonly thought. The second place I would note is I do have a housing recovery continuing, despite the fact that we get another 100 basis points or so on the mortgage interest rate. But I have a very shallow uptrend in housing because I think, in fact, if one looks at the fact that we've only gotten as much housing starts as we have, not much better than a million units when you think that equilibrium, just replacement, requires about 1.6 million. And I don't even get back to that level until late 2017. And so I think there's, to my mind, an excessive degree of optimism about how resilient the housing sector in the U.S. economy will be when monetary policy is in fact already turned into a tightening cycle. And I think that's going to be a bigger challenge for the U.S. economy than is commonly anticipated.
On the Germany question, I think starting with the broad-based nature of the recovery, I think the German economy is going to grow quite strongly this year and the next, which means about 2%. But that also means that all the countries in Northern Europe, in particularly, that's sort of very tied into the German in the German economy. The Netherlands, Austria, the Scandinavians, several Eastern European countries, they're actually going to do just fine as well. But in addition to that, you now have a number of the prior crisis countries, noticeably Spain, of course, but also the smaller Ireland and Portugal that are rebounding. So you get a boost and broad-based growth there too. I would certainly expect Italy to pull out of recession and France to tumble along, if you like, at around 1% as well. So this is the basis for the broad-based argument. Now, on the German issue itself, look, Germany has got a domestic investment problem. This is on the corporate side. This is not unique to Germany. You have low corporate investments in pretty much every advanced economies. But in Germany, it is particularly aggravated by what I would argue is an excessively rigid implementation of the so-called Schuldenbremse, or the German domestic balanced budget amendment, which have meant that Germany has been unable to do what would have been, both in the short run, in a financial sense, but also in the long run, the sensible thing to do, which is to have substantially higher levels of public investment in the economy. Because the reality is in Germany that public investments have been running at about 1.6, 1.7% of GDP on average since the euro was introduced, which is it's actually close to half the euro area level, and has meant that it's a country that has actually on a net basis been running down its capital stock, which is the principal in an accounting sense, reason for why Germany has now been running these very excessive current account surpluses and been accumulating all these net foreign assets. And I don't buy the argument that a country facing the demographic decline that Germany does needs to accumulate net foreign assets at nearly the pace that they have been since the mid-2000s. So they have essentially chosen to do that over investing in their domestic economy to get a higher potential growth rate, which I think is a bad economic policy choice.
Wow, that was an unexpected pleasure. Thank you, Jacob.
Monica DeBole here with the Peterson Institute. The question I have is for the panel as a whole, and it's just your impression as to, given these moderately optimistic projections, what is your sense about the whole secular stagnation debate?
We'll try to be crisp. Why don't we start with Jacob and move this direction?
Well, I guess from a European point of view, secular stagnation of productivity, et cetera, I think it would be predicated on a complete stop of regulatory and structural reforms in Europe, because I continue to believe that the euro area is an area that would have substantial improvements of potential growth and productivity if you implemented liberalizations and integration at the European level, whether we're talking about the digital economy, whether we're talking about the energy and utility sectors, or certainly beyond the banking sector, the entire financial services industry. So I don't really buy that argument because it requires me to be very pessimistic on regulatory reform in Europe.
Well, for China, I don't think secular stagnation necessarily is a very powerful argument, and I say that really for two reasons. Yes, China is the biggest economy in the world on a PPP basis, but on a per capita basis, they're at roughly 1/5 the U.S. level. That's about where Japan was in the 1950s, where Korea was in a similar time period. All these countries grew very rapidly for 20 years after that. So in terms of the potential for catch-up, again, given the right kind of reforms, I think it's very substantial. And if you look internally, there's a vast disparity in levels of economic performance as measured by productivity between the state sector, which is still very large in some domains, and the private sector. In services, for example, the share of investment by the state is 5 times higher than it is in manufacturing, and state service firms have a return on assets of half that of private players. So if they follow through on the commitment to liberalize, which I think they've made some progress on, and open up large parts of the service sector to investment by private firms, there's an enormous potential for increased productivity in the service sector, which is now absorbing more than half of all investment and accounts for about 45% of GDP. So I think, another way of just summarizing this, I think China's potential growth for the next decade is probably in the 7 to 8% range.
As Dick said very strongly at his last presentation of this kind here, there isn't an argument for a middle income trap for China. He's very much skeptical of that. And our absent colleague, Arvind Subramanian, made the case that the middle income trap actually doesn't apply to a lot of countries. So just to...
So in its starkest long-term version, I'm not buying secular stagnation. I think productivity growth in the United States, but I think also in other advanced economies, is going to eventually return to its historical averages. And in part, I think that simply because that's been the pattern. If you look at the last 100 years of total factor productivity in the United States, it's had periods of above trend and below trend growth, but eventually it sort of fluctuates around that. It has fluctuated around that average in relatively short periods of time frames. So I do think that over the next 3 to 5 years, we could have a global economy, a U.S. economy that looks something like the structural stagnation story. I do think, given how low currently the growth of the labor force is, and I do think there is a medium-term sag in productivity that's been associated with the fact that investment spending has been so weak, that the equilibrium real interest rate could be lower. And you combine a lower equilibrium real interest rate with the very low rates of inflation we have, I do think there are vulnerabilities that will look like the kind of concerns that people are worried about secular stagnation, and that could manifest itself if we got some negative shocks. So I think in the medium term, it could be that we find ourselves stuck at the zero lower bound, which is a manifestation of secular stagnation more frequently and with more significant negative consequences than we would like, even though over the longer haul, I don't really see any reason for there to be a world in which we have just chronic shortages of aggregate demand that we can't get out of. And if we were in that situation, I think it would be quite appropriate at that point for central banks to reconsider their inflation objectives and ask whether or not their inflation objectives have been set too low. One way to get out of secular stagnation is to give central banks more room to cut nominal interest rates, and one way to do that is to raise inflation targets. So even if we faced something that looked like a low equilibrium rate for a very long time, I think we have ways that we could respond to that.
I'm going to put in my 2 cents as well, and actually, independently, I come out very similarly to my colleagues. I think that there is a very real potential for confusing a run of subpar growth and a, what we, as Dave calls, a medium-term drag on growth from underinvestment with a trend. That was the fight we had over Japan in the 90s. And we saw that from 2002 to 2008, Japan had the highest per capita growth rate and the highest TFP growth rate in the G7. People forget that. These things are not necessarily as destiny as people think. And picking up on some things that both Jacob and Dave have said, I think a part of the untangling is there is still, no matter how much, even people who advocate fiscal spending tend to backwards assume that the impact of past fiscal errors is not very large. But by the time you start putting in accounting for the state and local government cutbacks and the other fiscal stance problems in the U.S. post-2010, accounting for, Jacob and I can disagree about the merits of it, but the accounting for the fiscal impulses that we saw in Europe, in particularly in Southern Europe, over the period of the crisis. Once you start putting all that in, the shortfall of growth to explain actually isn't as large as people make it out to be. And the final point I would add to that is, let's stipulate that my colleague's forecast is broadly right. I think it is. If that's the case, we're going to get 2 more years of steady growth, relatively steady growth in China, US, and upside surprise in Euro area. And you can throw in Japan even. And that will mean that the Raghu Rajan, now taken by Larry Summers and others, argument that you can't have growth without a bubble will effectively have been disproven. Mark my words, 2 years from now, we're probably going to be able to say that, and that will be a very good thing. Wait for the mic, please. Wait for the mic.
Thank you. Jessica Einhorn. I wanted to ask a question about 2 aspects of the global economic prospects exercise that we go through. And maybe one way of putting it would be whether we could normalize or whether there are 2 anomalous aspects in the comparisons. One would be on the demographics, which we know a lot about, but we don't normalize across regions in terms of saying what actually are the comparative growth rates taking into account the demographics. And the second is really the move away from, when we look at inflation, the move away from manufacturing into services in our economies, while at the same time our measurements are still based on manufacturing data that we pick up and not so much on services. And whether those 2 coming together would both help with the puzzles and shed some light.
Thank you very much for such profound methodological questions. No, they really matter. I would suggest Dave talk about the first, and then David, maybe Nick also come in, because the demographic and the services sector issues are so important in China. And Jacob, if he wants, can also come in.
Yes, so I mean, I think obviously a good point if you really want to know, in some sense, social welfare implications of these GDP forecasts, you want to know them relative to overall demographic changes. And clearly, looking at India at 7% versus the United States at 2.5% isn't very meaningful in that particular perspective. So I think we could probably certainly make some progress doing that. I do think in terms of these basic forecasts that I presented today, there is improvement in GDP per head across most of these major economies, and that's a good thing. So this is a global economy that in fact is experiencing some overall improvement, even though I sort of pose this as another disappointing year. That's disappointing because not so much of the underlying demographic growth, but just simply because so many of these economies have a lot of slack remaining, and they could grow significantly faster. Adam's certainly right to say that your question about service sector measurement versus manufacturing sector measurement is a deep one and a difficult one. And I think we've made our statistical agencies here in the United States have made some progress in improving measurements of the service sector. There's a quarterly survey of services that's now incorporated in the national income accounts. It's a significant improvement from where we were. But having said that, it isn't the same thing as counting the number of tons of steel to try to figure out what the output is of a medical procedure. I think that certainly raises some significant questions about whether the uncertainty about what we're able to divine in terms of overall economic improvement has increased, given that our economies are shifting much more in a direction of the service sector. This is just a little pet peeve. I'll say this because Janet Norwood, who was former BLS commissioner, passed away last week. She was a very important person in the statistical system of the United States. We are not doing ourselves any favors by the significant cutbacks that we've made in our statistical programs over the course of the last few years. And I think this only exacerbates the kind of challenges that you're presenting and our ability to overcome the challenges that you're presenting, that we're underinvesting significantly in something that actually could matter importantly in how we sort of view economic developments.
Do you want to add anything?
Well, services are a big problem in China, and as they've carried out a number of economic censuses, they have discovered a lot more services output. The most recent revisions of GDP, which go back about a decade, added about 3 percentage points to GDP, most of it in the service sector, but the first census 10 years ago added 16% to GDP, almost entirely in the service sector. So they have an economic system that was based on the concept of material product, which they borrowed from the Soviet Union, which basically didn't count services very much. And now they're transitioning to a more modern economy where they have to make a huge effort. And a great deal of service sector output is being provided by very, very small private firms. And again, they have trouble measuring those accurately, but I think it's improved dramatically.
I mean, just quickly on the demographic point, I mean, I think it is important not to regard demographic as destiny, in the sense that if you are an advanced economy today with relatively good growth and an open immigration policy, take Germany, for instance, probably the classic example. Germany had 400,000 working age immigrants in 2012, which is another way of saying that you can more than offset in the short run any decline in the working age population. You obviously, the aging burden is going to be there in a fiscal sense, but the outright decline projected in advanced economies' working age population can actually be reversed in the short run through immigration policies, which is probably something that the Abe administration should think a little bit about in Japan. And also in the long run, again, if you look at total fertility rates, they're not set in stone. I mean, there's a lot of things that you can do in the long run to bring them up, not to 2.5 or 3, but from the 1.2, the 1.3 that you see in a number of European and Northeast Asian countries to the 1.7, 1.8 level. That this has been proven by a number of Northern European countries, the Netherlands, Denmark, etc., which in the early 80s had demographic or total fertility rates of the 1.3 ranges. They are now at 1.7, 1.8, 1.9, because they have put in place a whole host of social policies specifically targeted to mid-career women. Because the one thing that's true for everywhere is that the age of childbirth has risen. And the question is of a country if they have the social institutions to cater for that or not. But again, it's not destiny. The worst outcomes can be corrected.
I really want to commend not just the can-do spirit of Jacob's remarks in the last moment, but also in his remarks on Europe, on the secular stagnation, but commend them analytically. You know, we make this abstract concept that there's a big difference between sort of exogenous TFP growth versus structural reform and that's sort of a catch-up. But, you know, 5-10 years of catch-up from structural reform is very good for government work. And over a 10-year period, distinguishing that from TFP growth is not that easy in light of some of the things you said. And so the idea that even the U.S., when despite ACA, we're still throwing away God knows how many percent of GDP on healthcare, the idea that there isn't room for the U.S. to improve its growth rate through that or through more sensible immigration policies, whatever. So I think the analytic point underlying both of Jacob's responses is really important. This is going to have to be the last question. Thank
Okay.
you.
Nasser Khilji with the U.S. Treasury, Economic Policy. Looking at a longer-term perspective, relative to your relatively optimistic forecast, I was thinking about Kalman, Reinhardt, and Rogoff and their predictions of recovering from, great recessions or financial crisis. And basically, I wanted your reaction to this recovery that we've had, the slow and long recovery since 2008. Is that their projections being borne out, or there is a different reason for this recovery to be taking place? In other words, is this time any different than what they were projecting? Thank you.
Before my colleagues respond, let me just throw in 2 quick points. The first is, I think far more useful on this issue, Reinhardt and Rogoff's book is a masterwork, but far more useful on this issue is an article that came out in the WIO a few years ago on persistent large output gaps by Daniel Lee and others. And I think that, and then there was subsequent work and corrections, but I think that's actually a better baseline for this purpose. But the second more important point is, I believe Romer and Romer just came out with a new paper that effectively challenges Reinhardt and Rogoff and says, it's actually, this is why I'm saying it, but it's in the spirit of my previous remark about fiscal policy, that Reinhardt and Rogoff, as just a matter of religion, don't control for policy response when they talk about the size of these crises. And it turns out that if you control for countercyclical policy response, you get a very different view. Now, again, one paper doesn't disprove it, but there is a difference of opinion out there in the respectable professional community. Does anybody want to add?
Well, I agree with Adam about that, and I think that paper is actually a very interesting paper that sort of sheds some light. You know, it is probably true that we're not returning, if your standard is returning to the trend in GDP that we had prior to the crisis, I think we're probably not going to do that. Now, there's lots of reasons for that. Whether part of that is, I think, the inheritance of policy actions that currently have led us to where we are today, and there's considerable hysteresis from those policy reactions to current levels of output. But I wouldn't rule out the possibility that the financial crisis itself did some fundamental damage that might have been even difficult to completely offset with policy, and that's part of the reason why GDP is likely to fall short of those earlier projections for where potential was going to be in the long run.
Well, thank you all very much. I think this was as riveting as macroeconomics gets. And for that, I'm grateful to Jacob, for Nick, and especially to Dave for putting this together. Thank you all for joining us.